Hello and welcome to this discussion with iShares, which looks at fixed income ETFs and the modernisation of the bond market. I'm Mark Dunne, the editor of Portfolio Institutional, which is a magazine looking at all things investment for pension schemes and other such institutional investors. And I'm sure you'll be relieved to know that you're not going to be hearing my opinions of how the bond market in Europe is evolving. For that, I'm joined by a professional. So let's meet her. Would you like to introduce yourself, please?
Hello, Mark. Thank you for having us today. So my name is Vasiliki Pachatouridi, and I'm the head of iShares Fixed Income Product Strategy in EMEA.
Thank you very much. It's good to have you with me. Thank you for joining. Of course, bonds are a big feature in institutional portfolios. And so one way of accessing them, of course, is through ETFs. So let's look at that market a little more closely. A good place to start, actually, is that 2022 is considered as the most challenging year for fixed income markets since the 1980s. But how have fixed income ETFs in Europe performed in the past year?
That is correct, Mark. Bond markets had a tough year in 2022 with negative returns almost with similar magnitude as equities. So we're coming out of a remarkable period of stability of both growth and inflation that lasted from the mid-80s until 2019 before the COVID-19 pandemic hit. So that period has ended in our view. So we're now facing constraints on the supply side of the economy that is our ability to produce, essentially, which in turn generates inflation pressures and slow growth. So on the back of this macro environment, ETFs have stood up pretty well. UCITS fixed income ETFs had around 20 billion of inflows in 2022, despite the rest of the mutual fund industry experiencing pretty significant outflows across European domiciled fixed income funds. Okay. We are continuing to see growing adoptions of ETFs, that's new users, especially institutional investors, which has been a trend for the past 2.5 years. And aside from the growth in usage, there's also been other developments in the broader ETF ecosystem and trading. ETFs trade a lot more. Trading volumes are up, both versus last year, but also ETFs pretty much trade more than double what they did pre-COVID.
Okay. You mentioned that fixed income ETFs continue to see inflows in 2022. That's despite outflows from the broader mutual fund industry. And why is that?
Well, in my eyes, it comes down to two things. First, it's the diverse set of investors using ETFs in a number of different ways. And second, it's the breadth and granularity of exposures and the product innovations that ETFs bring. So a good example is really the proliferation of sustainable strategies. So thinking about who uses ETFs and how, it's a very broad spectrum of clients, from multi-asset PMs, fixed income portfolio managers, that is bond buyers, all the way to traditional asset owners. And these types of investors, they all have different objectives, different time horizons, yet they all transact in one instrument on an exchange, which is extremely valuable, especially in fixed income, given the OTC nature of the asset class. This year, in 2022, investors turned to ETFs to adjust their portfolios ahead of the new regime of higher rates and higher volatility. They clearly valued the ability to make asset allocation shifts. We saw outflows from credit exposures and EM and large inflows into US Treasuries, for example. But we also saw investors being very dynamic and granular in managing the duration of their portfolio, so showing a preference for short duration, floaters, and ultra short ETFs. And then despite the macro headwinds for fixed income, we continue to see flows into sustainable exposures, with almost $1 in $2 of inflows going into sustainable strategies. Which brings me to the second point, why ETFs continue to see inflows. Really, it comes down to ETFs giving investors more choice and granularity of exposures. It allows them to build increasingly customizable portfolios to hedge risk and really capture a much wider set of opportunities.
Okay. But exactly how are institutional investors using fixed income ETFs in their portfolios?
Yes, as I mentioned earlier, there's a number of different ways institutional clients use fixed income ETFs, either strategically, tactically, or as a way to manage liquidity and hedge risks in their portfolios. But at the heart of all these use cases, there is a realization that you cannot build fixed income portfolios on a bond by bond basis anymore. Liquidity in the underlying cash bond market continues to be challenging, and even more so this year, with primary issuance being significantly down and the sell side reducing risk as well. So institutional investors increasingly turn to ETFs, but also other index-based derivatives as well, as a complement to individual cash bonds, especially in volatile markets. So ETFs provide a scalable and cost-efficient way to get exposure to hundreds or thousands of bonds in a single trade on an exchange. And these attributes are valuable for asset owners. A good example often being central banks as they look to rapidly scale up or down their holdings. Transparency of holdings and pricing, that is the cost of execution, which in the case of ETFs is known up front, is also highly valued. And last but not least, sustainability. Institutional investors are leading the transition to sustainable in fixed income, and they're increasingly relying on rules-based strategies to transition their portfolios. And I would say lately, the focus has shifted towards climate benchmarks and how they can be executed in a way that makes sense for a fixed income portfolio.
Great. Thank you. Is it true that index managers with the highest primary volumes, which means create redeems, suffer more during periods of market volatility? Is there a force of trade at a particularly bad time?
That is not true. I still think there is a number of misconceptions around how index portfolio managers rebalance their portfolios and execute on flows. The reality is that iShares fixed income portfolio managers, they use primary flows to rebalance their funds continuously on a daily basis, not just at month end. And the vast majority of creations, redemptions in iShares UCITS fixed income ETFs occur on an in-kind basis, which means that ETFs and its authorized participants, APs, exchange diversified baskets of bonds for ETF shares. So we don't trade flows on a cash basis. This process allows us to be very proactive, rebalancing our funds during the month with an eye on the forward-looking index. So we're continuously reflecting the evolution of the market as we go throughout the month. This is at the heart of our investment process. We do that during all markets, but the benefit of this pragmatic approach to trading becomes more noticeable in large AUM funds during volatile or stressed markets. And through the in-kind creation redemption process, ETF transaction costs are also externalized, which means protecting the existing investors inside the fund.
And finally, how do you think that ETFs will fare as bond market structures in Europe continue to evolve?
I really strongly believe that ETFs are catalysts for modernizing bond markets themselves. I already spoke about increasing liquidity of fixed income ETFs and broader ecosystem developments. We're seeing the borrow and the lending market evolving. We're seeing interest in ETF options. But from here onwards, I would say more data, more transparency, more electronification will only strengthen the case for fixed income ETFs and other scalable macro tools. For example, if we see greater availability of trading volume data and increasing electronification, that would lead to further automation, ease of access, and lower cost of execution. And we already see signs of that happening. Examples of increased electronification includes several brokers providing auto quotes on ETFs through RFQ platforms, which is accelerating the execution of smaller recurring orders, and banks building out their ETF algorithmic trading capabilities.
Thank you very much, and thank you for joining me to discuss what's quite an important market. And it's interesting to hear what's happening in these are quite challenging times, of course. But then we've got other things like technological developments, and of course we're all moving to different benchmarks now. We're getting more concerned about things such as the climate. So thank you very much. Thank you.
Thank you, Mark.
It's good to meet you. Hope to speak to you again soon. Goodbye.